This is a great question, and asset allocation is a hefty topic, so let's get into it. So let's start simple and say that your asset allocation just consists of stocks and bonds. An investor who's young and has a long time horizon might be willing to take on more risk. That person might be invested 90% stocks, 10% bonds, because stocks are inherently more risky and more volatile. Someone more risk averse might prefer 80%. Someone who's further along in life and has a shorter time horizon for investing might want to invest a bit more conservatively. An example would be 60% stock, 40% bond. If you want a more diverse portfolio, you could take a look at the portfolio that I use. I use a modified version of the David Swensen portfolio. The way I use that portfolio is I invest less heavily in bonds and more heavily into US stocks, because I'm willing to take on more risk for higher return. But also, don't take my word for it. I highly recommend reading this book. In the book, Tony Robbins mentions several different strategies for asset allocation. And remember, you can be diversified with as little as 2 ETFs or more.
Okay guys, so asset allocation is pretty straightforward stuff. It basically just refers to a mix of investments within your portfolio, right? So if we look at the different type of investments that you have, there's stocks, there's bonds, there's cash, there's real estate, and there's also private business. So those are pretty much the main things you can choose from. Also commodities like gold and silver and that sort of thing. But really what it comes down to is how much you want to concentrate or diversify your asset allocation, right? So you have those different groups, and then within those groups, how do you want to diversify your money? So some people think that, you know, it's good to put half their money in stocks and half in real estate, or half in bonds and half in stocks, or whatever the mix may be. Just whatever is best for you, you need to determine that. My advice is just to invest in things that you really know and understand, and just stay away from the stuff you don't know. So even if you're more heavily concentrated in a certain asset, in my opinion, that's okay, as long as you really understand that asset. It's better than putting in your money into things you don't know anything about, okay? So I'm not a financial advisor. I'm not telling you guys what to do with your money. I just want you to be aware of the different stuff out there. I'm just sharing what I do with my stuff. But what I do is I concentrate heavily into stocks. I like to own pieces of actual profitable businesses and hold them for the long term. So the majority of my money is in the stock market, and that's what I feel safest doing that. Okay, so hope you guys like that information, and we'll see you on the next video.
Good investors are aware that diversification is key in investing. You need REITs, index ETFs, corporate and government bonds, individual stocks, commodities, and industry-specific index ETFs. However, the difference between a good and a great investor is diversifying in a global manner. Since the US total world equity market value is 55.9%, it's fair to assume that most of your portfolio should be in US equities. For all my Canadian investors, we only comprise of 2.4% of the entire world. In my current portfolio, 55.94% is in the US, 13% is in Canada, and 30% is on the global market. I aim to diminish my Canadian equities and enhance my global equities by focusing my attention on the Japanese and Chinese markets. These three countries represent almost 70% of the total equity in the global market.
What are the top asset allocations in your stock portfolio? I'll go first. Pretty boring value assets, right?
I'm going to tell you how I determine the asset allocation for an investment management client. The first allocation question is between less risky and more risky securities. More risky being stocks and options, less risky being hedged equity investments, bonds, or commodities. We combine these to hit our client's risk target, which is usually relative to the S&P 500. Then, within the risky side of the portfolio, the stock side of the portfolio, we ask two questions. The first question is diversification. This includes minimizing variance, so picking some stocks that move together and other stocks that move separately, so that the overall portfolio is diversified from a risk standpoint, and then global and locational diversification. The second question is our clients' personal values. Some clients prefer to only invest in companies that focus on climate change, and so we provide them that exposure and then make reallocations on the risk